Welcome, everybody. This is a special edition of the Fundication Show. We have the opportunity via Zoom to have Aleksey Chernobelskiy, and he is going to be talking about what's going on with LPs in the marketplace. Let me give some background here in how this all came about. So Aleksey was online. He's very vocal about what's going on in the marketplace, and he's looking for solutions for LPs because what he does now is he advises LPs in maybe some of their next moves and how to deal with the current investments that they're in. Now, his background is he comes from a firm where they had acquired over $10 billion in commercial assets. And I believe that was 100,000 square feet in space, or maybe it was 1 million square feet in space. I can't remember now from the article. I'd have to flip back over. But tremendous amount of experience in the commercial real estate field. He was the senior vice president in that firm, and he oversaw the underwriting department. So he knows a lot about what to look for when it comes to transactions, but also how many are structured. And Aleksey, I would love for you to share a little bit about what transitioned you to the position that you're in now. Obviously, we've talked a little bit on the phone, but this is really just an opportunity for us to get to know each other in kind of a public setting where other people can learn from what we're seeing in the marketplace. I believe that even though we're not affiliated in any way, we both have a common goal, which is to advocate and empower the passive investor. PREIshare has created a secondary marketplace for those folks to be able to share or to sell and trade their LP shares. And we also have a fund that will buy those LP shares. So we're out there advocating for the passive investor, but also we're out there promoting good syndicators. And sometimes that's a little difficult to sift through. So again, I'd love for you to share a little bit about your experience and what brought you to the position that you're in now.
Yeah, Christian, thank you so much for having me on. It's a pleasure, and I'm excited to speak about a variety of topics. I think as far as background, to be honest, I noticed a pretty big gap in the marketplace. And it was pretty apparent to me that the education that's necessary in the space was not there. And I'm happy to dive into that, really how much you want. But the reality is simply that you have a lot of capital that's being allocated in a space, and the average LP made their money outside of real estate, right? And so I just wrote about this pretty extensively, and I have a pretty strong position on it that I don't know if I'm going to change my mind on this, but I think as of right now, the way that you get into syndications is you have to typically be an accredited investor. I think that status itself almost leads to confusion because just because you have money does not mean you're an investor. And I don't mean that in a negative way. I'm just saying, people make money through a ton of different ways. And I would say typically, if you look at the background of an LP, I would say probably 90%, maybe higher. The way that they made their wealth is actually not through investing. But you feel like an investor when you're in a deal, which is great. I mean, there's a tons of benefits of syndications, and I have an entire article on that as well. But I just fundamentally realized that there's a gap. On the one hand, you have this massive marketplace, a ton of dollars get placed. And on the other hand, let's say the average LP doesn't necessarily know how to sift through the information. You can sort of imagine a dentist in a dentist office at lunch, like looking at a deck. And they just have no idea, is a 6% acquisition fee normal? Should I be concerned about that? Maybe the rest of the deal is great, and should I be okay with that fee or not? And so, it's a very opaque marketplace. But at the same time, I think there is so much potential, and I figured I'd try to help.
Yeah, that makes a lot of sense. And I mean, I'm speaking to syndicators and especially passive investors every single day, accredited investors, and many of them are brand new to the market. And like you said, they've made their money elsewhere. And that's typically when somebody gets into passive investing, the guys that I know that hold a significant amount of wealth there, when they started, it was because they made their money elsewhere. So like you said, they were a dentist or they were a doctor or they were a tech professional or they, built a company and then they sold that company or somehow, pulled cash off the table. And so now they have this money and they're considered wealthy and wise by the government, right? That's kind of the accredited investor. They don't protect the wealthy and wise. They think they're smart enough to manage their own money. Whereas if you don't meet those standards, then you have a lot more protection from the government, but also limitations in what you can invest in. And so many of these folks are that I'm talking to, because we have ads out there. We're actually doing a raise for our own fund. And so I'm talking to these brand new accredited investors. And many of them are just getting hit with all these different numbers. They're not even sure what the difference between a cash on cash or an IRR or an equity multiple. They like the feel of real estate, but then they start realizing that there's a lot of different opportunities in the real estate world. And how do they sift through it, basically?
Yeah. And I mean, I can tell you just from my experience advising LPs on future positions that I do existing, which nowadays is mostly capital call advisory. But also on the future side, I get many calls, probably at least once a week, that goes something like, hey, I'd like to invest $500K into this deal. I'm really interested in it. But I know I can't really lose my money, but can you share ways in which I can benefit from the upside? And I just stop right there and I ask, like, why do you think you can't lose money? And what's funny, Christian, is the comments actually kind of make sense, but they're coming out of a lack of education. In other words, you'll hear answer like, well, like it's an asset. So worst case scenario, they just sell it and I get my money back. And it's like, okay, but there's a concept about debt and prices also change. Asset prices don't always go up. And then you'll hear something like, well, yeah, but everyone needs a place to live, which is sort of like a demand driver. Obviously, I'm referring to multifamily, right? You can kind of make up similar comments about industrial or whatever, but you're hearing these comments over and over and over again. And I think again, I think it's a space that has tremendous potential, but people need to educate themselves before investing, and I'm hoping to be part of that.
Yeah, it makes a ton of sense. And I do a little webinar about every other week where I talk about the big lie in syndication. And the big lie is that you're investing into real estate. Truthfully, you're investing into a company that is buying real estate. And so, yes, there is definitely more security when you're buying into real estate or a company that's buying into real estate, but there's still a lot of potential for fraud or, other situations, not even, fraud aside, which is, sometimes the big scare of, am I, getting into some sort of a Ponzi scheme? But like you said, there's all kinds of debt out there. Many folks didn't see what was coming in the debt world. And really in real estate, the only time you lose complete value of a property is if the bank takes it back. But unfortunately, we're starting to see some big scares in that. Let's speak to that a little bit. What would put a syndication company in a position where they are not able to hold on to their property?
Sure. I think simply said, it's this concept itself is not very simple, but to boil it down to a fundamental point, it would be a default in their lender agreement. In other words, maybe I'll explain it in a simple way. A syndicator buys a property, perhaps an LP goes into that syndication and is now a piece of the equity. But in order to buy the property, they also needed to take out a loan. There's an agreement between the loan, in other words, the lender, and the borrower, which is, the company that you have invested in as an equity provider. And the loan stipulates a bunch of things, right? Like typically they have covenants, certain debt yield that needs to be met, and a bunch of other things. And obviously that goes beyond just a simple idea of making payments, right? And what you'll see now that's pretty common is interest rate caps expiring, which is which in hindsight was a very smart thing for people to buy, but I think many people didn't expect interest rate fluctuations to last as long as they have. And so as soon as that rate cap ends, you effectively either have two options: buy another rate cap, but now they're a fortune, or two, start paying, in some cases 3 or 4 times more, which the company just can't afford. Like there's not enough money in the LLC produced by the property to all of a sudden pay this massive debt service, which is just interest and principal together. And as a result, you start going into kind of like a workout discussion with the bank, and anything. The only thing really you can do to avoid it is either make a capital call or find other sources of capital in order for you to survive. I mean, I don't know how else to put it.
Yeah. In capital calls, it's interesting because we're starting to hear a lot about capital calls, and many syndicators have never been in a position where they had to make a capital call. At least many of the ones that are currently in the industry. We have a lot of very new syndicators in the grand scheme of things that maybe haven't been through a market cycle like we're talking about now. And maybe we could talk a little bit about capital calls. And I would say there's kind of ethical and unethical capital calls is almost the way that I categorize them. Sometimes you're doing a capital call just to barely survive a little bit longer. Other times there's really a great workout potential, with more capital injected into a deal. What are you seeing out there, and what is the good and bad scenario? When would you tell somebody to go in on a capital call, and when would you when would you tell somebody maybe not to participate?
Sure. Let me start on your ethical versus unethical comment, because I think that deserves some unpacking. So I would say that all capital calls are ethical, as long as, and this is a big condition that I don't often see, as long as the GP is transparent about the situation. Being transparent about the situation includes many things, including, for example, in the best of their ability, explaining to the LP what their existing position is worth. You'd be surprised that, in fact, I'll say it the other way. Like I've advised on a ton of capital call decisions, and I don't think I've seen one case where the sponsor leads with the fact of, hey, here's where we are today. If we were to sell, here's what your equity is worth. But obviously it doesn't make sense to sell because X, Y, and Z, which is fine. Like all of those are sort of logical investment decisions. But overall, I think capital calls are, and I guess for the benefit of the listeners, there's really 2 types of capital calls. One is more planned, which is, like maybe you got into a fund and they're planning certain capital calls throughout the cycle of the fund. But here we're talking about unplanned. In other words, the property is fully funded. It was fully expected that money would last until the end. And then all of a sudden you get a notice. So in those circumstances, going back to your question, Christian, I think probably the most important thing is just viewing this decision as an investment decision. I often see very emotional responses to these things in either direction. In other words, either you see people that are extremely pissed off and how could you ask me for money, blah, blah, blah. I already gave you money, give me my money back, right? Like, that's one response that I typically see. Another response is like, oh my gosh, like I need to wire this money before Friday. I got to get it out right now before I miss it, and et cetera, before you do enough diligence to figure out whether it's a good idea to do it or not. And so I think that's really the biggest thing, Christian. I could talk about this for an hour as a topic, But what I would advise people to do is look at that marginal dollar as just another investment. In other words, let's say you put in 100 grand and there's a 50% capital call. In other words, you have to put up 50. So you have to think like, what return am I expecting to make on the 50 that I would not be able to make somewhere else, right? Where's my position today? How does all of that fit in? What's the plan? And what's the return on the entire 150 or the 100, even if I get diluted? And I have a whole article about this because I think this touches on, people tend to think, when you think about the prior money that you invested, the initial 100 grand, right? People say, well, that's a sunk cost, right? You already invested it. And I have a whole article about this because I think, although it is a sunk cost, there are consequences, typically, not always, but typically there's consequences to not investing because it'll dilute you. And sometimes it's not, a pro rata share of dilution. It's very punitive. And so because of that, I think you really need to understand what's going to happen with, so to speak, the 100 if you don't invest, what's going to happen to the 150 if you do invest, and just compare your options. And to be candid, like that requires some thinking. It requires usually, in every case that I've seen so far, some diligence from the GP that needs to be asked, and it's a pretty complicated decision.
Yeah, and I will say, when I led with an ethical or non-ethical, I would agree that majority are ethical, because if the GP is taking a position where they're standing up and saying, I'm ready to solve this problem. They're not burying their head in the sand. They're not, going silent. That is somebody who is committed to the success of the deal, and therefore they're investors. And I think the key is, if you're making that decision of contributing to the capital call, even if it may be a pinch on you, you have to have all of the information before making that decision. And sometimes that information is not freely given in the very first initial capital call, right? You might have to do a little bit of digging. What are some of the things?
I can add to that. Sorry, you can just finish in a second, but I'll tell you, like I'm pretty active on Twitter. And if a few days ago I tweeted about this because I just kept seeing that always the same template for capital calls. And in case any GPs are listening, I would sort of inverse what I'm saying and use that. I think what I often see is, hey, investor, like that's step one. Step two is everything is going really well, or some form of that. Step three is, hey, we need some money. Step four is, we're working on a plan and we'll get that to you. And then the final step is, but you have until Friday to wire the cash. Which, of course, as you can tell, first of all, this might seem surprising to people listening, but I think this probably sums up about 90% of the requests that I've seen. There's sort of like this urgency and sometimes a punitive measure to sort of scare you, let's say, into investing. But the amount of information that's given to make such a decision is limited at best, and sometimes completely missing. So in those circumstances, I would actually agree with you. Like something that is pushed out with urgency, without enough information, or at least even like bare bones amount of information, right? That starts to become unethical, because you sort of like wonder, does the GP, or in some cases, it's like even the fund of funds, not the GP, it's the fund of funds that invested into the GP. Do they actually like know what they're doing? Is there like are they a good steward of my additional capital? Right? Because they maybe didn't do so well in the first round. You know what I mean? So it becomes pretty difficult.
Yeah, and you see a lot of investors. I've been an investor for almost 2 decades now, and so a lot of us investors, we're very much optimists, and we like to look at the positive side of things. But when you're going to somebody and you're saying, listen, we need to do a capital call because we have to solve a problem, leading with the problem is probably very wise. Even if you have high hopes of what your solution is, I would say if you lead with the real situation, just, point blank, this is where we're at and this is why we're requesting money, and then build up to the upside of this is the potential for it and this is why we believe this works, you're probably going to have a lot more of a positive response, because many times, like you said, an investor invested their money in, sometimes that's the only money that they had thought that they wanted to put out into the market at that particular time. And now they're being asked to put more. And sometimes if they don't put more,
it's not just that they thought. In many cases, Christian, many LPs don't even know what a capital call is. Like I've gotten calls from people saying, hey, I got this email, some capital call or something. And they quite literally say, I don't understand what it means. Like, I thought I invested in a property, and not only am I not getting the dividends I was expecting, now they want money. Like, is this normal? Like, you're just like, this is the reality of the LP marketplace. Sorry, I don't mean to disrupt, but I think it's
you're right. And you become
in mind. It's like
you become part owner in this company, and so that means, depending on how the company is run, you have to be a part of that. And sometimes, like we had one LP, for example, that she's been an advocate of what we're doing since the beginning, but she's invested in a lot of different projects. She's invested with our CEO for multiple decades now. And she has one capital call where they basically came and said, you either make the capital call, and if you don't, it's an 18% penalty. So meaning the money that you have in is now starting to being taxed at 18% if you don't make that call.
Yeah, that's very common. And I've seen much worse than 18% for what it's worth.
Yeah. Yeah. So that's just, that's just an idea. I think many people don't even realize that they could be penalized for not putting more money in. Sometimes they think, well, I did my due diligence, I put my money in, and now, like you said, not only are they not paying me what they told me they were going to pay me, they're asking me for more money. And this is where it really comes down to, you are investing into a company, you become part owner of that company, and now you've got to be along for the ride, so to speak. And there's some due diligence items that probably people could do up front. I know we're talking right now about everybody that's already involved and maybe in a deal that is not going the way that they originally expected. But what are some of the things that they should look for before they invest?
Yeah. So I think there's 15 top things, which is, just the topic of my article. And I think for anyone who is listening to this, wanting the entire list, maybe you guys can link to it when you push this out. But I think honestly, where I would start is just a risk reward understanding. I see people put in $5,000, $10,000, $15,000 into syndications. And I thought long and hard about this, and I just don't think those make logical sense. And I'll explain why. That's a whole other article that I wrote. Again, all of these are on the same place. Put it in simple terms, it takes time to diligence in any investment, right? And I would say, especially if you're just starting, it takes a substantial amount of time, right? So if that's true, then by the time you're done diligencing a bunch of, let's say, 10 or 15K investments, you've already burned through, so to speak, the return on your own time for whatever you would have gotten on those 15K investments, right? So I like to say that you really need to have a substantial, not just net worth, but also sum of money that you're looking to invest. And then this is the whole larger discussion, but I think you need to be very wise in terms of not over allocating yourself to a single asset, a single sponsor, and so on and so forth. Now, a very relevant topic, I think, is just understanding risk reward with real estate. The reason why, in my opinion, diligence should take time is because real estate, generally speaking, is not an asset class that's going to, 10x your money. They're just not sort of the the risk reward profile that you should be expecting. I think, generally speaking, if you double your money over like a 5-year period, you'll have done really well. And I don't think anyone should be expecting to exceed that. If you do, great. But I think that level of return, which comes out to like roughly 15% a year, compounded, I don't think you almost you should not expect better than that. Now, the opposite of that is also true because upside is capped. So you should be very firm in understanding what your downside is. And I think I have another article called "Don't Lose Your Money," which literally just talks about this. In other words, I'll just give you an example. If you lose 50% of your principal on an investment, and then you take those proceeds, so you invested 100 grand, you got 50 back, you invested it back at 8%, which is already beyond the risk-free rate, so it includes some risk, but let's assume it's risk-free for now. It would take you 9 years to get back to where you were before you made that 100K investment, which is extremely painful. And what you'll see is, some people might say, oh, 50%, I'm never going to do that. Well, I can tell you right now, I'm advising people that didn't just lose 50%, but some of them lost 80% and 90%, and some of them lost everything. And so, of course, you never want it to be you, but sometimes it will be, right? So you have to make sure that you put enough time in on the front end to make sure that the downside is worth the upside. It's almost backwards in a sense. I think some people will say upside is the worth of downside. And in some sense, I think in real estate investments, I would say it's almost the opposite. And of course, going back to my topic on, not making YOLO investments that, you only live once. If you want to put in, like $5,000 into a syndication, and it's sort of like money that you don't really care about, then I would argue you should put it into higher risk stuff, right? Like, put it into venture capital, for example, where you might be able to get 100x on your money. On real estate, you just can't do that. If you're okay with losing it, then make sure your upside is commensurate with the fact that you're okay with losing it, right? So I'll just stop there, but happy to, continue on any other topics.
Sure. Yeah, no, it's an interesting way of looking at it for sure. And again, real estate has, the typical reason that real estate has been looked at as one of the best assets to invest in out there is that it has a good high rate of return, but also has a lot of security built into it. And where you start losing the security is when you have highly leveraged deals. Leverage is a double-edged sword. And I was actually just sitting with a friend of mine. He's a CCIM. He pulled up a course that they were going through, and it showed the difference in leverage of 70, 80, 90% leverage, and the difference of when that deal goes bad versus good, when the interest rate is low versus high. And man, it is a huge swing. And yes, on the upside, it's big, but on the downside, it's an inverse number.
Yeah, exactly. And again, I think when people go after assets, this, what they see is, to your point earlier, like the cash on cash or the IRR, and they fail to look at how levered this thing is, what other risks could come up. And I always talk about, in any given transaction, you need to make sure you understand what the top 3 downside catalysts are. If these 3 things go wrong, let's say really wrong, what could happen to your principal? And of course, some might say, well, what a doomsday analysis. But the reality is, like, many times, 2 of those 3 variables actually go wrong. Like we saw in the past 2 years, interest rates skyrocketed, right? And values dropped. And a bunch of other things. Like, I mean, there's like expense challenges, which obviously like impacts NOI. Rents aren't necessarily going up 10% a year in Phoenix anymore, right? So I think with everything, as an investor, you need to look at things through the lens of probabilities in a sense. Nothing is sure. And another thing I like to say is, if a GP is sounding overly confident in some variable that they don't have direct control over, such as interest rates getting cut, for example. This sounds funny, but like I would just tell them to go trade rates. I think as a GP, sort of as themselves, they can make a lot more money trading rates than buying real estate that might be impacted by rates. And so I think that's important for people to understand. I think people really like, this is a whole other topic, Christian, but people really, LPs love, oh man, look at this 30% IRR. This GP sounds so confident that, they've been on so many podcasts, or like they have so many followers online, or whatever, and they fail to not let those things influence their actual investment decision.
Yeah. How often do LPs either hear about an investment because their buddy got into it or their cousin got into it, or they saw something online and it just sounded exciting and they didn't really do the proper due diligence of the deal itself?
I think very often. And I do want to see the other side of this, meaning like if some random person comes up to you on the street and says, hey, do you want to invest in my deal? I'm a GP. Like, I think you should look at that, but you also shouldn't treat it exactly the same way as, let's say, your brother invested in something. He knows the GP and maybe he even got an exit that was good. From an LP perspective, those two deals should be analyzed differently. But my point is not as differently as many people actually make it. In other words, I think people overcorrect to trust people just because, again, maybe they have some sort of status as a famous person online, or perhaps, they're a family member or whatever. And many times those things just don't end well.
Yeah. I know over my years, I didn't do a lot of syndication, but oftentimes I would partner with folks, or they would lend money in a debt position. And I always told them, I don't care what you know about me. I don't care how much you like me. I want you to analyze this on the deal itself. And this is advice that I give people investing with me. So obviously it's the same advice I give for any investment out there. I don't care how much success that one individual has had or that group of individuals has had. I don't care how great their team is. If you're not analyzing the exact deal that you're getting into, you're only setting yourself up for potential disappointment.
Yeah, and I think this might surprise you, but I wrote extensively on what I call the 3 pillars of LP investing. And the 3 pillars are, the first one is execution, which touches on a bunch of things, but certainly like track record and trust and things like that in the GP. The second one is alignment of interests, which has a lot to do with GP LP dynamics when things go right versus go wrong. Of course, that includes the co-invest and the waterfall and the fees and some other things. And the third one is the property. And so many people reached out to me and said, hey, I'm looking to buy a property. Why is property third? And I think this gets back to your point earlier. I put property third for a reason, because I think the first two, in a sense, to your point, you're buying into a company, and there, as an LP, whether you like it or not, when things go south, you have zero control, more or less. In terms of probabilistic chances of doing anything, even legally, it's close to zero. So the first two are really need to check out, and of course, no deal is perfect. Some things will be missed. Meaning, in other words, you could have a phenomenal property, let's say, and I talk about this extensively there, but you could have a property that's just a phenomenal deal. And then you look up and you're yeah, but the alignment of interests are terrible. And I really don't trust this person. And that becomes an investment decision. You might say that, I'm okay with that because I really think this is a great deal. But at least in my opinion, there's a reason why the phenomenal deal at the real estate level comes third after the first two.
Yeah, and I would agree 100%. The more I have looked at different things that are going on in the marketplace, this is how we make our decision as well. So PREIshare actually has a sponsor approval process where we take people through and they need to submit their track record. We do background checks. We do all of these things in order for them to even be featured on the website or do anything that would be raising capital within our infrastructure, because we have a lot of LPs within our database. So we focus on that first. And the way that our CEO put it is he said, and he was big into race cars, right? He did a lot of racing back in the day. And so he says, would you rather have the best driver in the worst car on the track, or would you rather have the worst car? Wait, did I say that wrong? Best driver, worst car, or
with the best driver,
best car. You get the worst car, or you get the worst driver. It doesn't matter how good the car is. They're probably just going to wreck it anyways, right? They're going to put it into to the wall or something. And so really, it is you want the best driver first, and then you still need to look at the deal as a secondary and make sure that the decision they're making at this point in time aligns with what you're trying to accomplish.
Yes, I like that.
So what are some of the other things that you would say in due diligence are, and again, I hate using the word red flags, but let's just put it out there because that's kind of what you said in your writing that you did here, is that with your article, you said you don't call them red flags, but it's kind of what a lot of people use the term. What are some of those key things that you watch out for when advising somebody to invest in a deal?
Sure. So let me just start with why I didn't call them red flags. In other words, I called them top 15 syndication mistakes, right? The reality is that all investments come with some sort of uncertainty or risk, right? And so I'll just give you an example. One of the first, I think my first one on that article is just the split to the LP, right? So, typically you'll see like 70 to 80%, with the rest going to the GP, which is the promote. And what I wrote is, like if you see a number that is lower than 65, so you should just pause and think. That's kind of like the wording that I used. In other words, you shouldn't just be like, oh, red flag, I pass. Like you haven't gotten to the rest of the deal, and you should, of course, when you get to enough pause and thinks in a single deal, at some point, all of that collectively becomes a red flag and you pass, right? But like all investment decisions can't just be sort of like based on a binary thing. So just to give you an example, and I laid this out in an article too, actually. There's a hedge fund called Renaissance Technologies. Medallion Fund is like one of the most famous funds, probably I think to date the highest annual performance out of any hedge fund. They're famous for decades now for charging outrageous fees. And my point there was, at some point, if you're really good, you make your own market, and there's nothing wrong with that, right? Like if you're phenomenal at what you do, market fees or market splits or whatever don't really matter. So for example, going back to the split, you might look at a deal and you're like, oh my gosh, like a 50-50 split between the GP and LP, that's crazy. But then you look down and you're like, well, the deal is pretty good, and man, like they have a pretty good track record, and I really trust them, and there's a really good cool invest, et cetera, et cetera, et cetera. And you're like, listen, like maybe it's okay, and I think this I kind of call it a muscle, this ability to see deals at a high level and compare them is very valuable, because I think no investment ever should be thought of in a vacuum. I think people tend to think, I get a surprising number of calls from LPs, like almost freaking out, like, hey, like, I really have to get feedback by tomorrow, because if I don't invest, like I might piss off the GP and they're not going to send me more deals. Or, like the GP keeps following up and it's like so urgent. And I always tell them, like, like even within like the syndication universe, this is one of like hundreds of deals that are being fundraised for today. And that doesn't even factor in the fact that, you might go into another asset class, or you might even go outside of real estate, And so there's a big world of investments out there. You should really never feel pressured to do anything, whether it's on a future deal or an existing deal.
Yeah, I would agree with that. And in your article, you talk about the pressure, and you also talk about if you're looking at their documents and if it's overly salesy, right? It's kind of over the top, talking about all the upside. I mean, I look at most offering memorandums, especially put together by good attorneys, and it basically says there is a high chance of you losing your money. These guys don't know what they're doing. You're crazy if you invest with them, but go ahead and do so, right? That's like a good, well-written document. And you're saying that there's documents out there that maybe make you a little more leery when they're kind of overly promotional.
Yeah, I see a lot of it. And I think this is, again, it's not a red flag. It's a reason to pause and think. In other words, if you keep seeing, things that are overly salesy, so listen, it could just be that the analyst wrote it, and the analyst, I don't know, that's just how they think, and there's nothing wrong with it, right? However, it could also mean that they're making statements that are pretty difficult to back. And I'll just give you an example. I teach a monthly cohort of LPs that want to learn how to invest. And one of the deals that we look at is one that said, I think on the first or second slide or something like that, it says that, this is an unprecedented basis, right? So as an LP, when I read that, it's like, okay, a big statement, but let's see if it's true. And then you go through the deck, page 1, 2, 3, 4, 5, so keep going, and there's no proof for that, right? So what I want to caution people of is when you read something like that, you're not you just don't take it at face value, oh, okay, it's a great basis, cool, check, actually make sure that there's proof given behind statements like that. And listen, if it really is an unprecedented basis in the property and they've proved it to you, then I would even argue that maybe that gives more value or worth, let's say, to the other salesy words, let's say, that are being used. There's nothing wrong with words in general. And it's putting decks together sucks. I mean, I ran a team of 20 people doing this literally all day. So you can't focus on, do I use this word or this word, change this word? It's so silly to just make an investment decision based on one thing. But as an LP, if you see a word, make sure there's backup. And if there isn't, so, maybe the next word won't have backup either, and so on and so forth. You know what I mean?
Yeah, totally. There's one last thing that I wanted to make sure we covered in your article, because this is something oftentimes you see out there that again, makes you pause and think. And it's really a scenario where you start wondering, how do those numbers work together? And it's the last one in there where it talks about if in their assumptions, the first year, they're assuming that you're going to have an increase of revenue, but a decrease in expenses. How often do you see that in a transaction?
I mean, if I'm being honest, very often. And I'll tell you why. By the way, in some cases, this is actually achievable. But again, it should be a reason to pause and think, right? Because the reality is, in most cases, the financials that you're being presented as an LP is what I would call a pro forma on a pro forma. And I'll explain what it means. Typically, obviously, there's a seller, right? And I can tell you just from personal experience, I've seen this numerous times. Sellers might not be so sophisticated. They might have a balance sheet that doesn't balance. They might have some journal entries that they forgot to make at the end of the year that are pretty significant and would impact NOI, right? But they're just sending you the best they have, which is fine. No problem. So that's sort of like a pro forma in and of itself, in a sense, because the actual statement might be missing revenue, but perhaps more importantly, it might be missing expenses that they forgot to put in. So it's sort of like the seller's pro forma on how they do accounting. Then it gets to the GP, who is sort of like your steward of capital, and they look at the statement and they might forget, like, oh, well, let's just take this statement as it is. I can save on marketing expense. I can save on this expense. I can raise revenue. And that's how you get to this pro forma on a pro forma, which is sometimes like dangerously far from reality. If you look at sort of the actual, happy to, dive in more, but I just think, especially like on heavy value add properties, things take time. Things break, things don't work out, so like you really want to invest in someone that is being honest and conservative. And I think for that reason, I think it's a little dangerous to just look at decks for the IRR. And I hear this often, like people will like look at an IRR on a deal, and if it doesn't meet a certain threshold, they just pass. Because the opposite of that is pretty dangerous. People find an IRR of 25% and they say, oh, like, this is a great deal. And it's like, well, hold on, like, based on what? Like, you didn't even start looking at it, right? So it takes time to do diligence. And I think now we're like back to our original, the start of the conversation. When you get a year one pro forma that's better than the first pro forma or the actuals, you really need to stop and think, right? Because assumptions are being made, and mistakes occur. And like, that's why this takes time. It takes time to do these investments, which again, kind of takes us back to the original conversation of like, if it takes time to do something, and understand something, it probably doesn't make sense to invest 5,000 into it. It won't be worth your time.
Yeah, because if you are an accredited investor, typically your time is worth more than, let's say, $100 an hour. Sometimes $1,000 an hour or more. Right? You start thinking about what your time is worth and how much time you're going to invest. So, kind of recapping a lot of what we talked about is whether you're investing initially or whether you are being asked for a capital call, do your due diligence. And it's very important, the team and how much you believe in that team. It's almost kind of the leading factor. Is that team telling you the truth? Are they giving you all the information? And do they have a solid plan? But then you also have to look at the deal itself. What does this deal tell me? And if everything goes wrong, or 70% of everything goes wrong, how comfortable do I feel being in this transaction with the hopes that 90 to 100% of it goes right?
Exactly. Many times for what I find, I think because it's an asset and because there's just like this bias or forgetfulness, I guess, in thinking that asset values just continue to go up, people tend to not think as much about the downside. I mean, I literally hear this every week. And I wrote the article on not losing your money for that reason, because I'm hoping that by educating people what happens when you lose money, that doesn't mean that you don't invest. Of course you invest, and you need to stay invested. Unless you want to earn whatever 4% or 3% that your bank sometimes gives, you need to get out there. And I think more than anything, it's fun. Like you get to learn about different asset classes, learn about the GP, and it's a phenomenal place to be. It just takes time. And I think it's not for everyone, right? But I think it's important to distinguish that when you think it is right for you, you really need to be prepared for it and slowly learn and get your feet wet. Like, the first deal you see, like, you shouldn't be freaking out immediately and be like, man, like I got to invest in this to learn. Like this isn't the lottery. You know, it's your hard-earned money, and sometimes people just like sort of throw it around as if it didn't, as if it grows on trees, I guess. I don't know how else to describe it.
Yeah. And I mean, with that being said, I think, at least for me, I'll speak for myself. There's still a big advocate for real estate. I believe that it's the most forgiving asset out there. If you can hold on to it long enough, ultimately it has proven time and time again to hold value. But you also have to look at how you're investing, who you're investing with, and whether you're going to be able to hold on to that asset. So big advocate for investing in. And if you want true passive income, there's not many ways that I know of out there besides investing with the syndicator. And again, being in this for decades, being in the education space, seeing people, go out there and do short-term rentals or buy multifamily units or buy storage units, all of those things still take a certain amount of management. And even if you build a management company and you hire out all the pieces, you're still managing that management company. And if you don't build a management company and you just hire a management company, again, big downside is you have somebody else still controlling your money. And so if you want the true passive nature, I think real estate syndication is one of the best options out there for it.
Yeah. And I have an entire article on this topic too, where I essentially go through some of the reasons why I think real estate syndications are very unique. And I come from the REIT world, which is, public company. We invested across all of the US. I think there's a lot of benefits in investing in the public market. For example, being the liquidity. I think many LPs get into something thinking, oh yeah, okay, the time horizon of 3 years, in year 4, I'm going to do X, Y, and Z with the money. It's like, whoa, hold on. You gave the money away, and it's essentially at the full discretion of the GP when they give it back. And certainly you hope that they, get close to the timeline and everything goes according to plan. But sometimes things don't. I also see people investing in things, quite literally for the dividend, not realizing that sometimes the dividend stops. And it's like I've seen people invest in a development, ground up development, and it was advertised as a passive income play, which isn't necessarily false. It's just it's passive income play eventually, not immediately, right? And so a month in, the LP is like, hey, where's my money, right? And it seems so. I could almost see obvious, to someone sitting in our seats that you can't, the land doesn't generate cash, right? But someone who made their wealth in a totally different field, sees an interesting deck and wants passive income every month and might sign up for something without understanding that it's not an exact fit for their needs beyond just the deal itself.
Yeah, I would totally agree. You've got to look at those and understand that nothing is guaranteed and anything could be delayed. And I wouldn't forgive myself if I didn't talk about the liquidity factor that you had mentioned. We were really pushing to create liquidity that hasn't been seen, at least as far as we can tell, in the real estate syndication space by creating this secondary marketplace for passive real estate interests. Have you seen anything else like that before? And what are the typical stipulations that you're seeing for the LPs that you advise in their ability to liquidate their investment?
Sure. I think, for what it's worth, I think it's underserved in terms of the marketplace. I do know a few of your competitors. I don't know if they're massive in size or market share. But I think it's an important space, and sometimes people will reach out to me and say, "Hey, can I?" It usually comes in 2 different forms. Sometimes they want a loan on their position where you would take that as collateral, and sometimes they just want you to get taken out. I think, or them to get taken out. I think one of the challenges is just the fact that sometimes the LP agreements will require consent from the GP. That's probably one of the biggest hurdles. But But I also think forming relationships with GPs could be interesting for you guys as well. Because I think is especially now, like there's I don't want to say a ton, but certainly a material number of redemption requests. GPs, generally speaking, are not like cash rich, while still wanting to sort of keep their LPs happy. And perhaps there's an opportunity there.
And that is one of our big focuses. We definitely are out there talking to sponsors continually. We're helping to promote those that, again, pass our approval process, and also just offering this service because, our CEO, this comes from all of his years, 40 years as a real estate syndicator. And he always hated those conversations because his documents were written the same way as most of them that say you have to offer it back to the GP first. And if the GP is not going to cash you out, then you have to offer it to the other people that are already involved in the deal. And that really creates, not only is it limiting in who you can offer to, and potentially the timeline could be stretched out, but also all of those people know where you invested in at. And so it's going to be difficult for you to negotiate much upside, even if you got into a value add transaction, for example, and it's seen a significant increase in value. And so we believe with an open marketplace, you have that potential. And what we're finding, at least so far, not many syndicators want to limit their LPs from being able to do this because most of them are out there focused on the future. They're out there raising for their next deal. They don't want to have to pull money from their own pockets or from somewhere else to backfill a transaction that's already operating and already running.
Mm-hmm. Yeah.
So I guess big picture, and I don't know if you've taken the time to really think about this since we last talked, what do you think it will do for the marketplace if there is a lot more liquidity within this syndication space?
From folks like you, or what do you mean?
Correct. Yeah.
Look, I think broadly speaking, the illiquid aspect of syndications, I think makes it more difficult to invest. I think it's difficult but possible to build a marketplace that's efficient. I think, speaking to some folks today, obviously, like, when you have an LP position and maybe you think it's worth double what it's worth. So like someone on the other end, A, might disagree with you in terms of value today, regardless of owning it. But B, they also have to be compensated for the risk that they're taking on this position. Right. So when you sort of like A, account for the bid-ask spread difference, and B, compensate for the sort of the discount or premium, however you think about it, on the sale, like there's probably a significant delta many times between what like the seller is expecting and the buyer is expecting. But I think the really promising thing is, in some cases, it's like, who cares? All right. In other words, if there's a buyer and a seller, and the seller is desperate to get their money out today for whatever reason, a family reason or a liquidity event that they need, then let them out. And why should they sort of be blocked in a sense by the GP's inability to have cash? It's just, I guess, just my thoughts.
Yeah. Yeah, we see the same thing. And overall, we believe that will kind of figure itself out ultimately of what that actual value is. And if there is significant additional value in the property, but whether you can capture all of that, so for some people, isn't going to make the difference. In fact, I think that a lot of people that decide to sell their LP positions, they probably expected to be able to stay in long term, but a life situation comes up. Their kids get into college, you have a medical expense, they need to reallocate assets for one reason or another. And this just gives them the freedom to where they're not trapped in a good deal or a bad one.
Right. Exactly.
Perfect. Well, I know that, Aleksey, you have articles that you write, and there's a way that that people can get access to those. And you have some amazing information out there. You're continually being very active in this space, especially advocating for those LPs. How do people get access to it?
Yeah. So the website is LP Lessons chernobel.substack.com. I mean,
We'll put that right here on the screen. So if you guys are watching the recording,
we'll see it, I'm sure. Another way to just find me, I mean, I'm on LinkedIn. My name is pretty unique. So I think even if you just Google my name, you'll find my LinkedIn or Twitter, and you'll probably even find all my writings pretty quickly thereafter.
perfect. And is there a specific place that you would have somebody go first if they're wanting to learn more from you?
I think I would just check out the top 15 syndication mistakes article. I've advised a ton of people on existing positions that sort of went sour, right? In many cases, and looking at the original decks, I think you can see patterns, right? In what happens when someone doesn't ask all the questions. There's always sort of risks that can't be asked about or envisioned even, right? That's just part of any investment. But I do think that probably 75% of the time when I advise an existing investor, there's at least something that pops up that's like, man, like, I really wish you knew about this risk going into this deal. And that is a compilation, that those top 15 syndication mistakes article is a compilation of everything that I've seen in one place. And I hope it's, a really big resource to the community.
Yeah, I believe it will be. And I hope that anybody watching this, if you are an LP, we want you to invest. We want you to continue to go out there into the marketplace, but we want you to do it with your eyes wide open.
Yeah. I always say it's okay to invest into something very risky, but as long as you know that it's very risky, so sometimes I see this balance of many times actually, like people invest into something and only afterwards they realize that was risky, and you really, it's totally fine to, again, like put up $5,000 and invest into Bitcoin or whatever, and that it's a risky, volatile investment, but going in, if I invest into that, people are like, oh yeah, that's volatile. Like, I understand that there's a risk of me losing money. When people associate money with real estate, for better or worse, they just assume, well, I can't lose my money. And I think that goes back to an earlier point that over many decades, real estate is very resilient, but it's only resilient if the GP is good and you don't hand back the keys to the lender. Like if you're a forced seller at any point, that entire thesis of resiliency breaks down.
Yes. Yep. All of that is accurate. I agree with you 100%. And I appreciate you taking some time to be with us and bring this information to our audience.
Amazing, Christian. Thank you so much for your time.
Yep. And thanks everybody for joining us. We'll see you on the next edition of the Fundication Show.
Yeah. Thank you so much.
Well, thank you for joining us for another edition of the Fundication Show. And right now, we are in beta phase with our listing hub. So if you would like to get a free listing of your fractional share in a real estate syndication, just go to thelistinghub.com.